Hey there, welcome back to 7-Minute Books. I'm Sam, and today we're digging into Financial Intelligence for Entrepreneurs by Karen Berman and Joe Knight with John Case. So Sophie, I have to ask, did you learn finance the hard way, or did you actually take a class?
Hey there, Sam. Great to be here. I took one accounting course in college and it was all debits and credits, but I never really understood how it applied to running a real business. This book finally made it click. It's basically a survival manual for founders who don't speak finance.
I love that they start with the 3 key documents. It's like the vital signs of a business. I used to just hand everything to my accountant and hope for the best.
Right, and the first one is the income statement. It tells you whether you're making money over a specific period. But here's the thing. It's built on assumptions. With accrual accounting, you record revenue when you make the sale, not when the cash arrives.
That got me because I always thought profit meant cash in the bank. They say you can be profitable on paper while your checking account drains to zero. That's scary.
So the cash flow statement is the one you can't ignore. It tracks every dollar in and out. The authors say profit is an opinion, but cash is a fact.
And they give this killer example of a growing company. You get a big order, you buy materials, hire people, then your customer takes 60 days to pay. You're profitable on paper, but you can't make payroll.
That's a classic trap. So the balance sheet gives you the second piece. It's a snapshot at one moment, showing what you own and what you owe.
And the equation is assets equal liabilities plus equity. That's how it stays balanced.
Exactly. Too much debt makes you fragile. One missed payment brings it all down.
Then they get into ratios. I love that they say a number by itself is meaningless.
Right, like 100,000 profit sounds great until you realize you invested 10 million to get it.
So what are the key ratios for a founder?
The big 3 are gross margin percentage, current ratio, and inventory turnover.
Which one trips up most people?
I'd say inventory turnover. If you're holding products that don't sell, you're bleeding cash.
Yeah, because inventory costs money to store, and it's not generating any income.
Then there's leverage. Debt can fuel growth, but it's a double-edged sword.
You have to make loan payments even when revenue dips, so you're locked in.
Right. And they explain operating leverage, the balance between fixed and variable costs.
A factory with high fixed costs gets a huge profit boost from a small sales increase, but a small decrease can wipe them out.
That's the risk you have to understand.
The most liberating part for me was GAAP. The numbers aren't absolute truth.
Yes, different accountants can make different judgments. So the same business could show different profits.
I never thought to ask my accountant why they chose a certain method. I just accepted whatever number appeared.
And that's why open book management is powerful. When your team sees the numbers, they start thinking like owners.
So if a salesperson knows a 10% discount cuts the gross margin by half, they'll think twice.
Exactly. It builds a culture of financial awareness.
The one thing I'm taking away is that profit is an opinion, but cash is a fact. I'll check my income statement for performance, but I'll live by the cash flow statement.
And honestly, if you want to get this fluency, the whole library is on 7minutebooks.com/app. It has over 6,000 fiction and nonfiction titles you can read or listen to in any language, and it starts at $2.99 a month, $9.99 a year, or $19.99 for lifetime access. At its core, the book reminds us that the language of business is finance, and speaking it is what turns a founder into a true leader. We'll see you in the next one.